As of the last market close on July 2, 2026 at 4 p.m. Eastern Time, Datavault AI Inc., trading under the ticker symbol DVLT on the Nasdaq, finished the regular session at exactly $0.3841 per share, marking a daily decline of 4.90%, with a slight recovery in after-hours trading up to $0.39. While most retail investors looking at standard charts see this sub-dollar pricing as just another highly volatile microcap tech stock bleeding out in a harsh macroeconomic climate, the reality beneath the surface tells a completely different story. The massive trading volume spikes exceeding 34 million shares in recent sessions reveal that sophisticated institutional players are quietly accumulation testing this asset, hiding their tracks behind the chaotic daily swings of a typical penny stock. This creates an immediate curiosity loop for anyone participating in modern retail markets, because while the surface numbers look incredibly bleak, the underlying order flow suggests a massive tug-of-war between short sellers trying to compress the valuation and major entities positioned for a structural regulatory shift. The general expectation among average market participants using common investing sites is that microcap software entities trading below $1 are almost always structural failures waiting for a reverse split or terminal dilution. People log into their individual brokerage accounts, glance at a 500-day moving average, and assume a company with an accumulated deficit is a guaranteed losing proposition. This common ground belief is completely understandable given how many retail traders have lost their capital chasing unproven tech narratives over the past few years. However, the contrarian reality you must consider is that Datavault AI Inc. has built a massive intellectual property moat around tokenomics and data monetization that remains completely mispriced by standard algorithms. Investors frequently look at high-flying assets like Tesla stock or Apple stock to find technological leadership, but the real asymmetric upside is often found in the deep discounts of microcaps that possess foundational patents before a massive regulatory catalyst occurs. By looking past the immediate income statement losses, a sharper picture emerges of an enterprise building an underlying infrastructure that could fundamentally change how corporate enterprises value their proprietary data silos. When you look at the recent trading activity for DVLT, the sheer velocity of the price swings is enough to give any self-investing individual whiplash. The stock has been trapped in a wide 52-week range between a low of $0.2512 and a high of $4.10, indicating massive speculative pressure on both sides. In recent months, institutional distribution data shows that mutual funds and exchange-traded funds hold roughly 2.63% of the outstanding shares, while other large institutional investors control nearly 35% of the float. This is an incredibly high level of institutional concentration for a company with a market capitalization hovering right around $331 million. When you execute an order through an interactive broker's account or monitor the order book on an advanced interactive broker's platform, you can see large block trades hitting the tape during the final minutes of the session. This institutional presence explains why the stock managed to bounce off its absolute lows despite a wider technology sector sell-off that dragged down even the most resilient tech giants. The daily volume of over 34 million shares shows that liquidity is not the problem here. The true battle is over the immediate directional valuation of the underlying assets. This brings us directly to the market reaction following the first quarter earnings report of 2026, which perfectly illustrates the tension between expectation and reality. The market expected a steep loss, and while Datavault AI reported a net loss per share of -9 cents, which actually beat some internal consensus forecasts of -14 cents, the stock still suffered a sharp immediate decline of nearly 15% post-announcement, falling toward the 50-cent mark before stabilizing. Retail traders using standard mobile apps panicked because the company did not explicitly break down its top-line revenue metrics in the initial press statements, leading many to believe that commercialization had completely stalled. But if you look deeper at the corporate balance sheet, the business maintained roughly $250 million in total liquidity, with $140 million in working capital following strategic private placements. Management is intentionally keeping its cash reserves highly liquid to fund its capital-intensive projects, specifically the expansion of its infrastructure network. The short-term market reaction focused entirely on the lack of immediate revenue clarity, whereas long-term allocators recognized that the cash runway gives the enterprise multiple quarters of safety to scale its core operations. Comment below how many shares of Datavault AI Inc. you currently hold in your portfolio and whether you are buying this dip or waiting for more revenue clarity. To understand why this financial configuration matters, we have to look closely at the operational expansion that the company is currently executing. The management team has repeatedly emphasized that they are heavily reliant on the pending Federal Clarity Act to provide a definitive regulatory framework for tokenized assets and data vaulting systems. Right now, major institutions want to utilize data monetization platforms but are terrified of stepping out of compliance with federal watchdogs. Datavault AI has focused heavily on securing legal patent protections for its proprietary tokenomics models, ensuring that when the regulatory dam breaks, they hold the keys to the compliance framework. They are currently rolling out their Sanctum AI infrastructure across a planned 100-city network, an aggressive expansion plan that is consuming a significant portion of their quarterly capital expenditures. Additionally, the recent integration of their corporate acquisitions, including NYIAX and CyberCatch, have introduced near-term operational friction, driving up general and administrative expenses to over $25 million in the latest quarter. This spike in overhead is exactly what compressed the bottom-line earnings performance, showing that the company is spending aggressively today to secure a dominant market position tomorrow. Now let's step back and look at what this business actually does to see if the underlying model supports this aggressive corporate spending. Datavault AI operates primarily within the enterprise software and data management sector, providing a specialized platform that allows corporations to take their vast, unstructured data reserves, secure them in a cryptographically protected digital vault, and assign clear financial value to them through tokenized intellectual property tracking. Think of it as a highly sophisticated accounting and security layer for corporate data assets. The business model relies on a mix of upfront technology licensing fees and recurring cloud infrastructure subscriptions. In older financial periods, such as the middle of 2025, the company was generating modest quarterly revenues in the range of $1 to $3 million, which barely scratched the surface of their massive research and development expenses. Historically, the company operated under a different corporate structure before rebranding to Datavault AI in early 2025 to align its corporate identity with its heavy focus on artificial intelligence metadata and security tracking. Past performance shows a history of significant net losses as the technology was being developed and patented, which is exactly why the legacy financials look so unappealing to a standard quantitative stock screener. This historical context helps us frame the future outlook of the company, where the tension between expectation and reality will ultimately resolve. The bull case for the stock relies entirely on the successful commercial execution of the Sanctum AI Edge network and the realization of management's full-year guidance, which aims for a massive acceleration in the second half. If the company can successfully convert its preliminary discussions with enterprise clients in major media and healthcare verticals into binding multi-million-dollar subscription agreements, the top-line revenue growth will catch up to the current cash burn rate very quickly. In that positive scenario, the extreme discount we see today would disappear as analysts scramble to re-rate the stock based on actual enterprise software multiples rather than treating it like an unproven penny asset. Furthermore, any positive regulatory clarity from federal lawmakers regarding the status of tokenized data assets would act as a massive catalyst, immediately de-risking the business model for conservative enterprise clients who are currently sitting on the sidelines. Conversely, the bear case cannot be ignored, as the risks associated with a micro-cap company scaling at this pace are incredibly high. If the integration of the CyberCatch and NYIAX platforms continue to drag down margins without producing clear operational synergies, the company will continue to burn through its $250 million liquidity cushion faster than anticipated. Technical execution risks surrounding the physical rollout of the GPU edge network are substantial. Managing infrastructure across 100 cities requires flawless operational logistics, and any delays will result in immediate capital destruction. If the revenues remain heavily back-half weighted and fail to materialize by the end of the year, the market will likely force the company into further dilutive capital raises, crushing current retail shareholders. Investors tracking explosive growth trends often focus their attention on market darlings like NVIDIA stock, but evaluating a microcap asset like DVLT requires an entirely different risk tolerance and analytical framework. When you look at the options available for navigating these kinds of high-risk setups, modern retail investors have a vast